All right. So let's talk about today. Ideally, when we navigate the markets, we have this rush, right? This rush is to try and achieve the successes or the payout deadlines that some firms can put towards us, right? It's also the rush of need, right? We invest so much of our time into this, we invest so much of our money into this business that we need something out of it. And every time we fail, it's a bigger dent in our pockets that becomes a bigger stress as well. And it becomes a mountain of things that eventually overweighs on your shoulders and puts you down. These sort of things we got to try and obviously all of this that I'm about to say is harder, is better, easier said than done, right? But it's all of these things is something we have to kind of put into a corner and separate from our craft. When we engage into the market, we want to really try and be as mechanical as possible. Try and detach yourself from the emotional side as much as possible, because that need and all of those weights cloud your vision. It blocks you from seeing things as they should be. Now, with that being said, right, days or weeks like today where price action just chops. There's something I mention a lot in my section. It's like when I, in the end of the day kind of text that I do, that the market is not in my domain. I'm just gonna stay flat on my funded accounts, yada yada. There's a real specific reason why, because there's gonna be days where the market is just so easy. It's so easy to identify a setup. It's so easy to identify an entry point, and you can easily ride the entire wave towards the draw of liquidity you're aiming for. Those specific days come every now and then, and it's important that, of course, we make the most out of those days. But when those days are not present, we can't allow all of our work from weeks that we've done to simply come crashing down. It is why, ideally, you want to subject yourself to being not only disciplined, but be in motion with just persevering and preserving yourself, preserving your capital. Not everything you see happens on the day is worth taking. Not every day is worth even trading. There's a thing that people think that every day you must trade. It's absolutely the opposite. In fact, most day traders, all of them are unsuccessful. All of them are unprofitable. Day trading is actually one of the most unprofitable crafts there is when it comes to trading itself, just because of how easy it is for people to commit mistakes, how easy it is for people to be susceptible to the human error of emotions, bad judgment, or manipulation that happens in the market itself. The most successful people that I know happen to be swing traders or actually investors, but day traders I know very little. I'd say LMT is an exception, of course, and Amnaj, but an exception of how many thousands, how many millions. There are days where it's simply best to step away. And we can identify these days with a simple idea of, is price going towards a certain draw of liquidity? Yes. Alright, I'm going to play towards that draw of liquidity. Am I wrong? Okay, let's say you're wrong. Okay, why am I wrong? Let's identify the reason why I could be wrong. So for example, let's say this, for example, right here. You're looking for shorts, price made this massive sell-off, and now you're looking for shorts again. You think price is going to go for the sell side liquidity right here because it made a structure shift with a massive candle down. So you think this retracement is just going to be to continue going lower. Okay, let's say you go short. Price breaks through. Okay, you get stopped out after the invalidation of the busy. So you try going long. Let's say you go long. It's such nasty. But let's say you go long right here. Right, you hold it expecting highs, price dumps down, pushes back down, you get stopped out again. Ideally, these sort of motions in this range, you could say that price is essentially just gathering liquidity right here, not really going towards any draw until later on. the way that I like to navigate, at least myself, is that when I'm wrong twice, when I'm wrong going for the draw, and when I'm wrong trying to fade what seems to be the draw, and nothing happens, like price doesn't go to any sort of external liquidity, it just stays between the internal, it's a hint that price is trying to do something first before going to any sort of liquidity. Now, for me, that's kind of like a nice rule of two, right? If I'm wrong in the long and if I'm wrong in the short, then simply don't touch. Unless it's just like, oh, I got stopped out on a wick because of heavy manipulation. But if I'm wrong on both directions and price doesn't seem to break out of the range that it is, it's probably because it's only seeking to go for internal liquidity. And unless you're a scalper, it's not really worth taking those sort of trades, especially when price is slow or when price has, let's say, impending news going on for the previous next day. It is more important to try and class the trades that you take. Let's say the riskier trades for your evals and the A+ trades for your funded accounts. An example, let's say from our previous class when we were actually doing live trading with Asia. We found an A+ setup, a chef's kiss of a setup, and I was willing to take that in my funded. Because it was like a beautiful setup that reasonably, with everything that we know, because I'm pretty sure all of us have enough idea of how the market moves and how to read charts that we can make our own ideas and our judgments. The difference is kind of like the tiers of the trades of, oh, is this a good trade to enter my PAs or my evals? I, for example, start of the week, I've not had much luck in my evals. I've blown my evals. Some of them ended up green, some of them passed, but most of them got wrecked. If I had taken any of these trades in my funded accounts, I would have been absolutely back down and further away from payout than ever. It is discerning the quality of the market that we're in and discerning the type of PA that we're in and the setups that we're in that can help us avoid losing what's very important for us, and that can help us remain resilient to the conditions of everything. So what does an A+ setup looks like? It looks like with every time frame confluenting with the draw, with the trend. So hourly time frame, let's say, hits a fair value gap. Mid time frame, 15 minute, 5 minute, makes a bullish structure, bearish structure, whatever. 1 minute makes a model for an entry point. That is all you need to find an A+ setup. If it plays along the trend, if it plays along the draw of liquidity, if it makes the mid time frame structure that shows it can reach that area, and the 1 minute entry point for the exact or the most high quality entry you could potentially do. That's your recipe for an A+ setup. That's how you can ideally avoid rough markets, rough situations where you don't know the possibility of success. Now, how often does an A+ setup appear? Not very often, right? Because otherwise we'd all be rich. A+ setups appear rarely. They appear every now and then. And that's why it's important to be, relatively picky. If you see, or if you tell yourself, I'm only going to take A+ setups in my funded accounts, you have to commit to that. Because at the end of the day, this is something you really need a payout, right? So if you really need a payout, then why would you expose yourself to potentially losing that account instead of playing it as safe as possible and trying to make it happen as soon as possible? Because here's a little experiment that I've been doing. I see from my cataloging for myself that I am way more profitable taking 1 or 2 trades a week. On a side of another funded account I have, I've managed to exponentially grow that account way better than I've been able to grow my trade day account, which I've been grinding every single day trading for like the past months that you guys see me live. Because there's a difference in quality and a difference in market. Ideally, you're always kind of putting yourself in a handicap whenever you try to trade every day. There's going to be better days than other days. And the better days are super obvious, because you might be saying, well, Tyrant, how do you know if a day is going to be a good day and how it's going to be a bad day? Well, when you open the charts at any point in the day, can you clearly see and think to yourself, I know where price is going. This seems super obvious. This looks like it's going to do this and this. Why it's going to do this? Because of this. Easy read. If that's the first thing you can think of the moment you open the market, then you are good to trade that day. It means that you probably are going to be getting the right trade, and it means that it's actually going to be a refreshing and easy day. But if you open the chart and you think the first thing is, what the fuck is this shit? What is Nasdaq doing? This looks disgusting. Are you? Why would you expose yourself to trading your important accounts in that? I understand, of course, you see me trading it, you see JD trading it, but you got to keep in mind, we have a lot of experience. We have the means to do this. And also, we're more focused in education than in anything else as well. If I didn't do streaming every day, I wouldn't be trading every day. There are days where I would simply just not even bother looking at the charts. And that these past 2 days are a day like that. I haven't touched my funded accounts these past 2 days because there's nothing to do here. I see price do these moves that I've taken in evals with you guys, but I don't see it worth taking in my funded accounts because they're simply not the price action that I like, or it's simply not the structure that I like. There's a clear difference when you know what the market is doing and when you're indecisive of what the market is doing. And of course, yes, that's also a thing, right? The rush of having to make the number of days in. That's the game that the prop firms have, right? That's how they're so profitable as well. They force you to take trades. You know, when me and Jess were talking today, and she mentioned how the window for a payout is between NFP and I think it was CPI. Well, of course, because those 2 weeks are the most ruthless weeks of the market, usually, especially the one in NFP. So it's obvious that people put themselves way more susceptible to losing it. A thing that LMT says all the time is that even if you don't manage to make, let's say, the payout window, just keep compounding and grow it exponentially. And I think that's a really important thing as well. He got denied 5 times in a row from Apex, and he didn't bat out. He just simply compounded again and again and again and again, non-stop, and eventually just got a payout whenever he could. And that's ideally the way that I'm approaching it now. I would love to achieve another 40k this payout cycle. And ideally, I did kind of need these past 2 days for a trading day with my own sizing to, get those days in. And for them not to count it as flipping. But for me at this point, it's like, you know what? Even if I don't make the cycle, I'm going to rack up enough days throughout the month to request the payout the first. Possibly. But as I do that, I'm also limiting myself to blowing the damn account. I'm also putting myself in a situation where I'm not going to blow the account because I'm not exposing myself to rough markets. I'm also being the most pickiest when it comes to the setup that I see before me and that I'm going to take. This is the kind of approach that we should have in this business. We want to be picky. We want to be specific with what we want to risk. If you let Apex or the prop firms beat you in your mentality that, if I don't take trades in this exact day, then I'm not going to get paid, it's going to kind of hold you back. And then it comes this. Let's say you are green, right? You have $3,000 in, let's say, your Apex account. You're about to request a payout, but you decide to take one more trade because you needed the day. The trade goes wrong. You're red. I'm going to try and make back that little red that I made. You're wrong again. Then you get that itch, right? We all know that itch. The itch of just letting the account be green. And then it starts spiraling. Another bad trade. Do you try to make it back by doing double the leverage? Just one quick, easy couple of points. You get it wrong. Or maybe you do get it right. But then you get that itch that, okay, maybe this time I'm going to take one more trade just to get some profits. And then you're back in a hole. And you start digging a hole for yourself where you were so close to payout, but now that you're so far from it again, you're worried that, oh man, I just need one more good trade so I can reach the payout amount of 2,600. And then you blow it. Next thing you know, by forcing it in conditions that are not for you. When the markets are easy, you're going to make a crap ton of money. But when it's hard, you're not going to make anything. You're probably going to blow your accounts. And that's why it's also important to have a limit loss to yourself. Some people can't control the limit loss. It's a mental thing as well, right? If you think, I'm going to stop at minus 200, you say that to yourself, you don't do it. I think it's really great tool that some prop firms have, an actual forced limit that you can manually do for yourself or customize to yourself. That way it forces you out. But it's really just that discipline of knowing when to engage and knowing when not to. This sort of price action, the draw to me, is confusing. I don't know if it really wants to go lower, I don't know if it really wants to go higher, because every time we attempt to go higher, it failed to displace fast. Ideally, low resistance liquidity runs versus high resistance liquidity runs, the difference is very easily perceived. In this case, you see a price, no matter how many times it pushed up, it struggled so much. This is not worth taking a long trade, even if it's struggling so much. And every time a price pushes lower, it makes a big knife and then continues to struggle and then reverses. This is nasty. This is low conditions. Great conditions are going to look or sound like the following. Great conditions is where PD arrays are respected. Price bounces from a PD array to another PD array to another PD array and then looks for a liquidity. It makes a shift, it respects, and pursues. That's great conditions, in my opinion. Conditions where you simply see a model appear and there's none. Think of it like this. Usually expansion, retracement, consolidation, expansion, retracement, consolidation, market maker buy models, market maker sell models. That's kind of how you want to see things move. From every little consolidation that happens to continue until the draw of liquidity is swept. And after that, you crash out. You're done. You also want to limit your trades. Less is more. Unless you're, let's say, a win rate trader, and that's a bit different. Because there's two kinds of traders. There's the risk to reward traders, and then there's the win rate ones. Win rate ones, of course, scalping is their game. I'm not a scalper, so that's why it's not my game. But in that, I can't really speak for them. But let's say for risk to reward traders, the ones that hold trades till their reward is hit for a specific amount of risk, our objective is to get one home run and to wrap things up, to limit our exposure into these markets as much as possible, because you never know if the next trade you take is going to be wrong. And you got to assume, this is also important, always assume that you're going to be wrong, because you cannot enter a trade and not be comfortable with the idea that it's going to lose. You have to, any trade you take, you have to be okay that, okay, I'm going to bet, let's say $200 that this trade is going to work. Be comfortable just immediately imagining that it did not work and you just lost 200. So think of it like sacrifice. I'm willing to sacrifice this amount to make this. Didn't work? Whatever. It was an amount I was comfortable losing, that I don't mind losing, because I know my model, my skill, the people I trust, the ideas that I create to the ideas that I follow are consistent enough that even if I lost this amount in this trade, I'll make it back the very next one, and I don't need to overtrade or I don't need to expose myself to anything else. For example, and there's times that, let's say, how can you control this, right? Let's say we were long somewhere around here and price knife down like that. That would have been an automatic stop. Now, for our manual, let's say, stops, right? We're manual traders. I would encourage to have a hard stop placed, because the market tends to do these kind of things now, to have a hard stop placed at a certain amount of capital that you're willing to lose in, let's say, a big manipulation that were to happen as well. That could help out, because a situation like this is hard to control, right? You never know. It's like, oh, you hold it, it's probably going to retrace, and then bam, broken. So that's a big thing to also keep in mind. It's good to have your manual and then have your hard stops always in mind and always placed, always having that sort of discernment of how much you're willing to expose yourself and that little extra that you're willing to do just in case. Because if you don't have that, then you might eat up an entire move like this. And also try not to be stubborn when holding a bias or a trade. If you're stubborn, holding to your ideas, you get that tunnel vision. And that tunnel vision really just, that's also what makes or breaks it, right? If you see a price is trending up higher, doesn't show any bearish structure, doesn't make any bearish move really, the best choice is not to short. Oh, but price is so high up, would you go long? Well, no, we're such a high premium. Going long seems like the most difficult thing to do, or more the most dangerous thing to know, because you never know if it's just going to start making the reversal right then, right? So what do you do in this scenario? Nothing. Well, I would do nothing unless you're chasing the trend, because these are conditions where simply both sides are risky. It's just what makes them make the most difference is your risk sizing. Because let's say you enter tiny here, you don't mind if you're wrong, but if you're right, you can practically hold it all the way up. So risk sizing properly, like a couple of micros, makes a big difference in a scenario like that as well. Uncertainty uncertainty for the success of a trade can be compensated with right sizing. If you see, let's say, the long that we took, let's go to where we were taking our trades. I think it was right around here. It was right here. This is where we took our trade. How can we compensate with sizing? Let's say you guys have I know some of you guys have 100K accounts, possibly bigger. You love to trade with your minis. If you think, let's say going long here, that you can't afford a loss in your minis of 62 points, but this is the invalidation of the setup right down there, then what you could do is mitigate that loss with sizing. So if let's say 2 minis here is 20 microns, right? So what you could do instead, by mitigating it, is doing 5 micros. 62 points with 2 minis is, how much is that? I don't know the math in my head. Right, that would be 2,500. And if we did 5, that's 600. So the risk of what you're exposing yourself to is decreased substantially. That you could actually be wrong in this idea and you will not get your account hurt, assuming that you're trading, let's say, a big account. That way, you can remove that hesitation, you can remove that uncertainty, and that way you don't also have to stress out about, like, let's say, oh, this trade has to work, otherwise I'm gonna be hurt. No, it's a trade that, if it works, fantastic. If it doesn't work, well, you're not gonna get hurt either, because it's a drawdown much less than what you were going to feel. A drawdown like that in, let's say, 2 minis would be 10 points, right? Something that can, around 20 points. Something that can easily be amendable, I believe. 25, something like that. Another thing would be, of course, it's common mistakes. It's common mistakes that make us susceptible, especially when things are rough, right? Or let's say this case right here, right? I was confident that we were going to go up, but I did not take these in my funded accounts. Structure-wise, why would I not take this in my funded accounts? Let's go through the 3 things, right? First of all, it's not an A+ setup, but let's go through all of them together just so you guys can see how thought process should be. Where was that? This was 10 a.m. Right here. So, we know that the market should be moving from premium to discount, Price reached 930, retraced into its fair value gap right here, shot up, beautiful. The draw of liquidity is clearly this buy side liquidity right here. It's trying to go from the sell side curve to the buy side, like that, right? Okay, you have your bias, you have your draw of liquidity. Now if we measure from the very bottom to at that point the very high right there, discount is right around here. Too steep in the downside to retrace into, so anything above here really is kind of chasing. And if you measure it from, let's say this, oh, that's the wrong tool, point A to point B, we've already surpassed equilibrium, so we've already recovered more than 50% of the range. So after 50% of the range, that's ideally not where you want to do your entries. Ideally, that's when you want to really wait for a retracement. But there are some things here that were confluential for the price to move up, right? We had that structure right there in the 15-minute. We have the 5-minute order block. And within all of that nonsense, we also had the 1-minute structure that was going on right around there. Keep losing it. Right around here. The structure indicated the price was bullish because of how it was respecting the PD race. But we consistently saw how much it struggled and how much it failed to displace higher. You got to keep in mind practically that the 1 minute isn't what does direction. Direction is made by higher time frames. It's made by the hourlies. It's made by the mid time frames. That's what really creates the direction of where the arrow is going to be shot. But the way that you let go of the arrow is based out of the 1 minute time frame, in my opinion. So if you see this, and you know that this is supposed to be what triggers the move up higher, and it looks terrible, it looks unreadable, then this to me would be B or C tier setup. This to me is like, it could make any sort of moves before leading up to the move that I'm looking for, even if the draw is higher, and it's much more risky. If I don't want to risk the invalidation point of 63 points in 2 minis, then I should enter it where it would hurt less. If I entered 5 micros, it would feel like if I took a 30-point loss in 1 mini, right? So that way, you halve your risk exponentially. You also limit your emotional factor, assuming that you do take this. But the right judgment would be to not really take this at all, especially, let's say, this one right here, even if it respected here, because you never know if it's truly going to offer you that move that you're thinking, just based on how the conditions are. You read this, it looks messy. Something that looks really good is something that looks, let's say, textbook. Like the setup of the other day that happened right at 9 a.m. that I missed out on. That I was pretty salty about. This is a textbook setup that we all know. This was right at Q3, and this had the 953 root candle confluencing with it. So, why is this the perfect setup that you should definitely take comparably to the others? Had a stop rate, had the inversion right at Q3, closed above it, retraced into the 953, respected it beautifully, also hit a high time frame PD array. Oh, where was that? Man, I keep losing these setups. Was it right around here? Yeah, it was right around here. Hit the 15-minute order block right there. So we had mid time frame, we had high time frame, and we had small time frame, all confluencing together to make it work. You missed the setup because I was convinced price would take the low from earlier in the morning low for heading up. Okay. Did you miss the setup simply because of hesitation and doubt that your idea would work? Even if it was present? Okay, you're convinced we'd go lower first. That's doable. Now, in a scenario like this, it's important not to avoid the flags that go against you, right? Even, let's say you're short biased and everything. Ideally, if you're short biased and price failed to expand lower from this SIBI right here, you gotta keep in mind that price is most likely to retrace into its premium area for continuation lower. What changes all of that, oh no, let me rephrase. If we're looking for a move towards a certain direction, we want it to be fluid, right? Consistently doing, let's say this, if we're bearish. Retracing into a PD array, respecting and continuing lower. At no point do we want the structure to completely break. Once structure breaks, you gotta put yourself in a situation where you can look at the other side as well. In this scenario, let's say if you're bearish even, it respected the SIBI, fantastic, you enter short. Price took out the low, you didn't exit because you thought it was going lower. It came right to this point. This is a key point where price needs to respect this, because if price did not respect that, it meant you were most likely going to get stopped out. It failed to respect it. Why would it fail to do so? Because it probably has either a will to come back into a premium to go lower, or to straight up reverse into liquidity above. So this invalidation, or in fact, let's say you do get stopped out, you could try re-entering upon the very first retracement or the moment the price opens the next candle. And if you're hesitant, you can minimize your sizing so much that it becomes either, oh, if I'm wrong, well, it's just going to be a super light hit. But if I'm right, I'm going to be able to ride it all the way to the liquidity that we have right there. It's like in those scenarios that I do my mechanical trades right here. So let's say in today, I took 2 eval trades, right? Same idea. Well, I took 3 technically, but the same idea applied. I entered here. We endured the chop in my eval. Price knifed down. Ended up blowing the account. Okay. But I saw a wick right up. The idea isn't invalidated. The idea still matches with the draw of liquidity. It still matches with the mid time frame. So just slap it. If I'm wrong, then price should break down here. Alright, I accept that risk on my eval. I don't mind it if I'm wrong. But if I'm right, I know that it's going to go towards the specific highs of all the way up here and possibly even higher. And just entering, just no hesitation. You enter with a sizing that would not hurt you. You want to make sure that anything you enter is something that would never hurt you if you were to, let's say, be wrong 5 times in a row. Because that's how I've been trying to do with my funded accounts. I'm trying to enter trades to the point that if I'm wrong 5 times in a row, I'm not going to be hurt. Because getting hurt is how you lose your mental fortitude, I would say. You get hurt, you're like, oh, I have to make it back. You're not able to stop. You're not able to control yourself or be disciplined to have the right judgment. It's, I have to make it work, or I might, why either if I stop now, I might miss out on a future move that would put me back in green. And if I don't stop now, I could miss out on the payday. If I don't stop now, I can miss out on the trading days. Or if I don't stop now, I'm not going to make the cut for, let's say, the payout because I need a certain amount of capital. It's the conditions that make you not allowing to stop that really holds you back. So it's really important that you do not let the market hurt you. Because when it does hurt you, you know, that's when your brain turns off. You want to make sure that always your sizing is adequate to what you're risking. You're always making sure that you lost. You assume that you're always going to lose all your trades. And you want to make it so that no matter the structure that develops in front of you, if it's not the invalidation, size in so that if it becomes invalidated, you're okay. And you can immediately flip bias. You don't want it to be so that, oh, I'm entering here, but I'm entering a size that I'm not comfortable with being wrong with, so I'm going to exit the trade here. When it came back down, exit. Oh, but I still think it's going higher. I'm going to go long again. Came back down, exit. Oh, I'm going to try another time because now it's looking like it really is going to go higher. Came back down, exit. Oh man, that's 3 times I tried going long in the same exact idea that I had. I'm not going to go long again because it failed 3 times. Oh, and then shoots up. Oh man, my idea was right. I can't believe I let that happen. I'm going to chase the move. Let's assume that you chase here. Let's assume, right? Price knives. That's the death of your account right there. All of this could be avoided if you simply sized lighter in a way that if you entered the very first time, even if price pushed down here, you would be okay. As long as your idea did not become invalidated, you are okay. Because this is the mess that really screws you over in choppy markets. It's the mess of, I have an idea, but the price action internally is so bad that I'm hesitant, so I'm going to cut it because I just can't handle those losses if I were to be wrong. But if I enter a size where I can handle it and I can just hold it and not care for the outcome of the trade, then this becomes invisible, really. It becomes frustrating, of course. Like, I get frustrated watching this, but it becomes invisible to what? It becomes invisible to actually hurting you and turning your brain off. Is how I would put it. And ideally, when we do our, let's say, oh, well, how do I know the invalidation point of my setup? Usually, right, assuming you're taking an A+ setup, it should be the swing low or swing high of a 5-minute setup or 15-minute setup with a 1-minute entry. Assuming you're a risk to reward trader. If you're a win rate trader, then yeah, absolutely, you could rely on 1-minute structure to just invalidate yourself, because win rate is different approach in scalping everything. But assuming here, right, this would be, I would say actually this would be a point where I would have been stopped out if I was, let's say, taking this as a 1 minute structure only trade. This would have been technically the stop out because this is the very swing low. Price ended up taking the swing low before pushing up. It would have induced me out. Technically, it did induce me out before shooting up. But that would have been one of those scenarios that, okay, I know I'm going to be right. I get back in. I took a small loss. So it doesn't really matter because I'm okay. And I'm going to enter. And since I'm a risk to reward trader, I know that I'm always aiming for 2R or 3R. So even if I'm wrong, when I'm right, I'm going to make it back twice. Let me just read some of the comments. Stop, this is literally how I traded that segment. Yes, Swag. It's definitely, it's hard to outgrow this, but it's really important because this is what really just kills the accounts. The commissions, the constant mental capital, because it's also mental capital that exhausts in this whole move. And then when you're wrong, or if you're right, how it spends up your head. Because let's say you do miss out this. That stress that builds up in, oh, now what do I do to make it all back? I was right. I can't believe I let this happen. So all of this reaches to a breaking point, literally a breaking point for the trader where you just stop caring and you take any trade you see, forcing it to try and work. When you're in chop, the best recommendation is either don't touch it, but let's say you do touch it, or the trade unfortunately went from being good to being choppy, which is something that happens a lot to us in stream, right? That, okay, we think it's going to expand, and oh, now that we're in, it's choppy. That's why like I keep saying, it's key to have the right sizing and to have the right management, but also to have that detachment. Because if I enter the trade here and I don't care whether it chops really, although it might be frustrating, and you don't care that it's not going to hurt you, it releases so much weight from you. The outcome, and if you assume that you're wrong from the get-go, it releases so much weight from you that you do not care about any mess that choppiness brings. Now, of course, it's frustrating to see that it fails to expand and whatever, but since there's no real danger in any of this, you're going to be okay. And that's the biggest thing. You need to understand that red days, red weeks are okay. You don't need to win every day to be profitable in this business. You only need to win on the easiest days, and you need to survive the hardest days. If you do so well for an entire week, but one bad day blows your entire account, something's wrong. Not just in, let's say, oh yeah, the day was hard. No, something's wrong, because there's no way that you can spend an entire week working hard to make gains and then lose it all in an entire day. If you lose it all in, let's say, 3-5 days in a row, completely understandable. Rough market, hard times, you blew the account, happens. But if you lose it in one day after so much time of working on it, then it's simply you stepped in front of a wall, and no matter what, you just kept pushing your head against that wall thinking you were going to walk right through it. How do you size smaller than 1 micro? These candles will be 30 points each. How do you maintain 200? This drives me so much. It takes like that. Yeah, that's why I say these candles have been insane. That's why I'm also relatively flat these past time in my funded accounts, because there's really not actually a way to do smaller than, let's say, 1 to 2 micros and have that 200 drawdown. Like, if one candle stop is 30 points and you're doing 1 micro, that's already 1/3 of almost hitting 100 point draw. We're almost hitting 200 points, the $200 of drawdown. So it's rough, and that's why it's good to be, like, let's say, picky, right? For me, at least in this case, I do not want to trade my funded accounts if one candle is 50 points, if 1 minute candle is 50 points, because that's practically, if I enter 2 micros, I'm wrong once, I'm done. And that happened. It was in the stream with JD, where we were doing the duo stream. I entered in my funded accounts. I got stopped out, hard locked out of my accounts in 1 candle move, and then price ran towards the direction that I had. I only made profits in my evals, but my funded accounts were red. It's just one of those moments where I thought to myself, man, if I simply did not trade, I would have not lost, even if I was right. And that's what led to me also not taking trades this week, because it's simply, these candles, the price, it's not giving me what I know I need to make a lot of money. But on a day where it's giving me something I need that's gonna make me a lot of money, I'm good. I make my money back, or I make even more. And it's that perseverance of just waiting for the right moment. Because if you're just trying to trade every session, if you're just trying to trade every setup, like I said, I'm not overreacting here. Day trading is the most unprofitable business between all sorts of forms of trading. Day traders suffer because the market is made to make people liquidity. And the more setups you see and the more setups you take, the higher probability it is that you're going to get wrecked and lose all of the work that you've done. RiskSync will save us on these bad days? Yeah, that as well. You know, technically, right, I lost the account, but I passed 2 accounts in the same idea because I didn't RiskSync it, but that was definitely a move that you could have done as well. Oh, I enter longs here, right, because I know that there's a fair value gap here and price can pump up. But I also know that over here, there's a 5-minute order block and price can pump up from here. So I'm going to enter one account here. I'm going to enter another account here. And let's say he hits the 50-minute fair value gap. I'm going to enter another account here. Days like this can work out like a charm. Most often, that's in fact how, you know, Amnage and LMT conquer their markets. They RiskSync. They do aggro. But but the key thing is that they are always mitigating the risks into different accounts. So instead of entering, let's say, light here, like I've been suggesting, they can enter the normal size here, their normal size here, and their normal size here, because that's divided into 3 different aspects. The account they don't care about, the account they kind of care about, and the account that they really care about. And that way they technically always win, but they also don't suffer too much. So enter 1 micro, then illustrates moving our direction. That's another way that you could do it, right? So let's say, not in this setup, but let's say in a setup in general. Price hits a fair value, this is not a fair value gap, but let's assume. Price hits a fair value gap right here. It has to disrespect this SIBI for it to succeed. It just has to. There's no other way. It has to break through this, otherwise we're going to get stopped out. You enter 1 micro, you see that invalidated, respect it, you can enter another one here. Your average gets raised up to, let's say, around somewhere around here probably. You put your break even and you hold price as it goes. That's a way that you can also differentiate the risk. You enter light on the risky entry, you enter full size once it confirms the outcome of the trade, or it confirms the possibility that it has higher success to run towards the direction that you're looking for. The real way to navigate specific choppy markets is just to really manage your risk very well and to kind of just block out or mitigate the possibility of getting mental fatigue by blocking out all of those little errors that happen. It's definitely recommendable that you have like a little bit of notes around your monitor or a rule set that you can type out here with an anchored text, really saying, let's say, if price moves 50 point per candle, enter 1 micro. Just something as easy as that. And you're like, okay, let me see, is this moving more than 50 points per candle? Oh yeah, this is moving 50 points per candle. I'm not going to risk heavy sizing, going to enter 1 micro. Little notes that you can have around, and if it's an anchored text, it's always going to follow you, so it's kind of hard to avoid seeing that right there. Also taking advantage of the firm you're working with. If you're working with Rithmic, set auto locks for yourself. If you're working with TraderVet, I know some of them don't allow it, unfortunately, but try and be disciplined and just believing in yourself that, okay, I can end the day red, no biggie. Because what really makes positive expectancy is understanding that red days are better than you just losing everything that you worked so hard for. It's simply being able to say, I'm okay being red. I'm okay losing this idea. I'm okay just taking 1 trade a day. I'm okay missing out on moves. I see JD killed it every single day. You know, sometimes I hop in PM session, he's in a trade, he's making 50, 100 points easily. I don't FOMO. I don't feel like, oh, I have to take the very next trade JD takes because he's probably gonna get it right. Nah, I took my win. I'm okay with my win because I know that as long as I secure green, I'm green. Because you never know, maybe JD gets a bad trade, like we all do, and then you set yourself back, and like, oh, now I really need to get back green. That urge. Since we are here, is that downtrend then stop run to the 5-minute OB, or is that a break of structure, market structure shift? So at no point did we make a market structure shift. You gotta keep in mind that shifts are better. If it's an SMT, then it's understandable that you might think this is a shift right here. But this isn't an SMT, nor was it a stop rate. So first of all, liquidity was never rated. And second of all, price never displaced below the previous low. So you always want to see it displace firmly. So in this case, I would never consider this a market structure shift. This was simply a trap. No, not a breaker. I mean, yeah, I guess. Yeah, it is a breaker. You got me there. That is a breaker. An ugly one, but it is one. I hope that this has been insightful. If you guys have any questions or something you'd like to ask specifically, go ahead. It's a little conversation anyways. For sure, Deathly. You know, Nasdaq is also really volatile, right? It's also unrealistic to like try and have a small stop loss or to be super picky with the stop loss. Like, oh, I'm gonna have a 15-point stop. Nasdaq moves too wild for that. So if you're gonna enter a trade, you have to be, mindset ready. If I'm going long here, I can't have a hard stop of 15 or a set point stop loss, because then what happens here, right? You enter here, stopped out. Enter again, stopped out. Enter again, stopped out. And that's 30 points. Let's assume you have a 10-point stop. That's 30 points you lost. But if you just simply entered once and had your 30-point stop, that would have been all the way here. And I guess in this case, you could say, oh, I got stopped out. But let's say you got stopped out once, you get back in, you make it all back easily, or instead of just, let's say, well, expending your mental capital, right? Of course, you could get back in and then be back at break even, but it's avoiding that little extra. Well, that could be like your perception, Joss. For me, it was very like wild. Literally respected anything. Any other questions or comments? I'm glad you guys enjoyed it and find it very insightful. I will kind of leave, let's say, a few more words, at least how my plan. Maybe you guys can get something out of my plan since it's how I'm managing my things. After I got my payout of 40 and I blew the accounts right after, I decided to get the lifetime subscription because definitely slow, at least for me, slow has been better. And just knowing that I know how to read the market, I know I'm skilled enough to have the right judgment when something is going to go towards the draw and when something isn't, and when I don't know when something isn't. I'm taking it really slow where I only take the best of the best. If I, in my opinion, right? If I think it's really good or if I think, this is doable, I'll take it. I know it's hard, the time, right? The time for me is a big thing, right? The amount of time you put into this, you need something to come out of it. You need it's like something just has to happen that is beneficial, or even if it's just like a couple of bucks. The time and money that you put into this business, just something has to come out. But slow is definitely the way to take it. Like so many times, I've tried doing it fast. Every time I try doing it fast, I fall off. As much as I keep doing it, even if with the same skill set and everything, the rush is my biggest downfall. So for me, slow has been better, less has been more. It's definitely not easy to get to. I missed the first. I was planning to get paid on the first, but I didn't, because I got a red day, and I missed out on the amount that I needed to get the day. I easily could have tried staying for, let's say, JD's stream or the PM session and tried making it all back and making it till the first so I could request that extra 40. But I didn't, because I knew from my prior experiences that whenever I get into that mindset, I blow the accounts. So this time, my approach was different. My approach is, I don't care how long it takes me. I'm just going to compound my wins. Because, at least I'm copy trading 20 Apex accounts. But 40 grand is a ton of money. So even if it takes me a month, even if it takes me 2 more months again, because it took me 2 months last time, I will take it as slow as possible. I will mitigate my risk as much as possible. And I will compound until I achieve that milestone so I can withdraw. But until then, I'm going to avoid days like this in those accounts. I'm going to avoid over trading. I'm going to just take one setup that appears that I think is worth it, and then I'm going to close those accounts. And I'm going to, I'm going to get that itch out, because we all have that itch of taking a trade, that itch of saying, what is this guy doing? His idea seems pretty good. Maybe I'm going to take it. I'll get rid of that itch by trading evals. I get rid of the degenning by trading evals. I make this setup could work. I want to take it. I'll take it in my eval instead of taking it on my funded, because I don't know if it's really going to work. I don't know if the long that I took here is going to work. It's not a high tier for me, but I want to take it. So I'm going to take it in an account that I don't mind if it fails. I lost my first eval here. I didn't care. I didn't bat an eye, because it wasn't my funded account. My funded accounts are fine. So as long as it doesn't matter, it's fine. As long as I'm not hurt, it's all fine. And that's kind of how I'm planning to reach the second payout that I'm trying here. Just doing it slow, doing it consistently with the compounding, not stressing out about these moves, not missing out on anything like that, not caring about the days, because that's the thing. These firms, they know psychology because they know how to get to someone's head. The days are the biggest thing for people. If they catch you flipping, they deny your payout. They catch you over trading with greater size and then doing really light size, they deny your payout. They force you into a cornerstone where you have to do their game. And their game is meant to make you fail. So you have to overcome their game by doing something that you don't do yourself, which is, following your rules. Everyone has their own rules, but they don't like to follow them because it's uncomfortable to do so. But you just gotta. You do not have to technically trade your PAs every day. Technically, you only have to trade your PAs once a month, I believe. At least that's how it works with a lot of different firms. But that's my insight for what I'm doing, or at least what's my plan with my fundeds and how I'm treating them. I have a max loss of 200. I usually aim for 50 points or more, and that's it. I could definitely aim for a lot higher, but I try and cut it with one good trade. If it even gives me 30 points or less, I try and cut it, because the less exposure is better. and just trust in yourself, because you are around very talented people. You don't have to rush this business. You don't have to try and chase. You know, you could think that, oh man, I see, let's say the Gap trader, right? She's posting these gains of thousands every day. You might think, man, I want to make that. I'm going to try and do the exact same thing they are doing. But you're not ready for that, because every other trader's in their own individual journey. And you don't got to rush what you're doing to try and match someone else, or try or be jealous and try and reach what they are, because everyone's starting differently. Everyone's on a different path, and everyone has to do what they're. You got to do you. You got to focus on doing you, only you, until you make it out of where you're at right now. Honestly, trading, that's the same thing, right? If you have light sizing, trailing drawdown doesn't really affect you. Trailing the drawdown is a death sentence for people that use heavy sizing. It's a death sentence for people that are not consistent and trade normal sizing. But if you do relatively light, you're fine. It doesn't really hurt. Like I could take, let's say, my profit is up 200, but I don't secure 200 bucks. That's fine. The next trade can make it back easily. It's different though if, let's say, you're up 500 and you do not secure 500. Then that's rough. But also for evals, at least my approach to evals is a lot different. For evals, for me, it's kind of like SL, blown eval, target, passes the account. So that's a different approach entirely. Alright guys, that's the end of today's class. I hope it was insightful. I hope you guys enjoyed it, resonated with you. I will see you guys tomorrow morning. Hopefully a price action clears up. Hopefully we get a nice setup that I can actually take. Otherwise, it's going to be a bit disappointing. But there's nothing that can be done, right? If the market isn't giving me what I can use, then I'm just going to have to be flat tomorrow too. And that's okay. This is recorded, so you guys will be able to see it whenever you want. And I hope you have a lovely rest of your night.